Is this just a technical turn? Is it inflation? Is it maybe something more insidious?
Brian, I think it's the realities of reopening as we start moving out of the initial phase of the reopening, and we're starting to see some of the consequences of all this stimulus getting put into the system at this point in time. And so there's a lot of discussion out there about inflation. People are watching 10-year bond yields. You mentioned earlier here in the show that 10-year bond yields haven't gone anywhere. But if you step back and you actually look at where tips have gone, and that's sort of an anticipation of inflation, they've continued to move higher while 10-year bond yields have moved basically nowhere. So there is inflationary pressures building. Whether they're transitory or not is the key question that I'm getting from every single account that I've been talking to over the last several days since this month's publication came out. And Brian, I got to tell you, I would say all the commodity side of this definitely can be transitory. But when you start reading through all the news and all the things on CNBC, there's wage increases happening all over the place. And whether this was by design or whether this was really just a overall minimum wage increase going through, nonetheless, wages are going up, and that's only a one-way door, not a two-way door like commodities are. So, Brian, at this point in time, I look at this market and I'd say there are inflationary pressures building, and I think the biggest risk that investors are dealing with right now is the Fed going to make a policy mistake at this point in time? And I think that's what everybody's wrestling with, and that's why you're getting the volatility you're seeing in the market right now.
Well, let's back it up just a bit because, Craig, I think you understand my point in the bond market. The bond market generally is the tell for inflation. At least it has been for decades. The 10-year yield hasn't done squat in 2.5 months, been stuck pretty much at exactly the same level. So is that maybe more of a reflection of all the debt that's out there? Is the bond market kind of losing its role as the inflation tell?
I don't think it's going to lose the inflation tell. I think you've got, bond purchasing happening by the Fed. They're obviously trying to control rates, control things at this point in time. So I think at this point in time, it's still a tell, but I would also bring into this discussion, Brian, if we look at sort of the copper and gold ratio as an inflationary discussion, with copper being a indicator of inflation, gold being sort of a risk-off type metric. You look at that ratio and you sort of project that out and you look at the correlation between that and 10-year bond yields. Brian, it's projecting that 10-year bond yields should be at about 2.93% at this point in time. So if there's anything that investors are certain about, is 10-year bond yields are going to be moving up. So the question is, how do you address your portfolio? How do you restructure it? And I think that's where investors are really starting to focus.
Okay, so I'm going to ask you a genius question, Craig. How do we restructure our portfolio? Answer your own question. What are we doing right now? See what I did there?
I was hoping you were going to ask that question. So what we've done recently with our model... What we've done is we made a couple big changes. We downgraded the technology sector for the first time in 5 years from overweight to neutral. We also upgraded basic materials from neutral to overweight, and we also downgraded healthcare from neutral to underweight and upgraded transportation. And really the crux of what we're seeing in here is we want to be positioned in overweight basic materials. We want to be overweight basic materials. We want to be overweight the consumer cyclical stocks or discretionary stocks, and also financials, as we think that in this sort of rising rate environment, which we do believe is going to come, those stocks should outperform tech, given the sort of long-dated kind of open-ended growth stories that have gotten to be very expensive, in the market at this point in time.
Yeah, there's names, though, that down the road, because May to Labor Day, obviously we know the history of it. The markets historically tend to do very little. Volatility does come up. That's not scaring you away from a name like a FedEx or a Cisco, but I don't mean Cisco Systems. I mean the food company, SYY. There are companies that you still like right here in a market of stocks.
Absolutely, Brian. Look, we're still looking for 46.25 by year end. So we're talking about another 12% higher. I do think we are going to get volatility here coming through the sell and may go away months through the summer. But there are definitely things to do. There's always things to do. FedEx still looks constructive. Cisco Foods looks constructive. I'd even say on the consumer, take a look at Guess. another constructive downtrend reversal. Also in the financials, JP Morgan, Truist Financial are other examples of constructive looking names. And then don't forget about the basic materials. I mean, Alcoa, very nice uptrend. The copper stocks still look constructive, and we'd still be owning those. And then also energy. Look at EOG and the longer-term downtrend reversals that are happening in energy. There's zero question that the market is sort of reorientating toward a higher interest rate environment. And I think, again, the risk is going to be higher volatility. And is the Fed late is the big question investors are really trying to answer.
Shepard Smith here. Thanks for watching CNBC on YouTube.